inflation and interest rates, two of the biggest forces shaping your financial future. They determine the value of your savings, the cost of your loans, and even how much your investments grow over time. But here's the problem. Most people don't truly understand how inflation works, why central banks raise or lower interest rates, and, most importantly, how to invest wisely in different economic conditions. In today's video, I'll break it all down in simple terms. We'll cover 1. What inflation and interest rates are and how they affect your money. 2. How governments and central banks manipulate these forces. 3. The impact on stocks, real estate, gold, and crypto. 4. My personal investment strategies for different inflation and interest rate environments. By the end of this video, you'll know exactly how to adjust your investment approach to protect and grow your wealth, no matter what the economy is doing. What is inflation, and how does it affect your money? Inflation is the silent killer of wealth. It slowly erodes the purchasing power of your money, meaning what you can buy for $100 today might cost $110 or more next year. But what actually causes inflation? Too much money in circulation. When central banks print more money, there's more cash chasing the same amount of goods and services, driving prices up. Supply chain disruptions. If goods become harder to produce or transport, prices rise. Wage increases. If wages go up faster than productivity, companies raise prices to cover costs. Now, why does this matter for you? Because if you're holding all your money in cash, you're losing purchasing power every single year. Let's say inflation is 5% annually, and you have $10,000 sitting in a savings account earning 1%. In reality, you're losing $400 per year in purchasing power. That's why investing is essential. It helps your money grow faster than inflation. Why do interest rates go up and down? Interest rates are the primary tool governments use to control inflation. When inflation is too high, central banks raise interest rates to slow down borrowing and spending. This reduces demand and brings prices back under control. When inflation is too low, central banks cut interest rates to encourage borrowing and spending, stimulating the economy. Here's a real-world example. In 2020, central banks worldwide lowered interest rates to near zero, making it cheap to borrow money. As a result, people took out loans, invested more, and stock markets surged. But then inflation skyrocketed, so in 2022 to 2023, central banks started aggressively raising interest rates to cool things down. This cycle directly impacts 1. Mortgage rates. Higher rates mean more expensive home loans. 2. Stock markets. When rates rise, borrowing gets expensive, which slows corporate growth. 3. Savings accounts. Higher interest rates mean better returns on cash savings. Understanding this cycle is key to making smart investment decisions. How inflation and interest rates affect different asset classes. Now, let's talk about how different investments perform when inflation rises or falls and when interest rates go up or down. 1. Stocks. High inflation and rising interest rates. Bad for stocks. Companies struggle with higher costs, and borrowing becomes expensive. Low inflation and falling interest rates equals great for stocks. Companies can borrow cheaply, expand, and profits grow. 2. Bonds. Rising interest rates. Bad for existing bonds because new bonds pay higher yields, making old bonds less valuable. Falling interest rates. Great for existing bonds because new bonds pay lower yields, making old ones more attractive. 3. Real estate. Rising interest rates. Slower home sales, lower property prices because loans get more expensive. Falling interest rates. Boom in real estate as mortgages become cheaper. 4. Gold and commodities. High inflation. Great for gold and commodities as people look for safe haven assets. Low inflation equals less demand for gold, so prices stay stable or decline. 5. Crypto. High inflation and low interest rates. Crypto does well as people seek alternatives to cash. Rising interest rates. Crypto struggles as people prefer safer, interest-bearing assets. This knowledge helps us decide when and where to put our money. How I adjust my investment strategy in different economic conditions. Now, let's go into how I personally invest when inflation and interest rates fluctuate. Scenario 1. High inflation and rising interest rates. I reduce exposure to high-growth stocks and focus on value stocks with strong cash flow. I invest in commodities like gold and silver. I keep some cash in high-yield savings accounts or short-term bonds to take advantage of higher interest rates. Scenario 2. Low inflation and falling interest rates. I increase my exposure to growth stocks, especially in technology and innovation sectors. I buy real estate if mortgage rates are low. I hold fewer commodities and bonds since their returns are lower. Scenario 3. Mixed inflation and interest rate trends. I diversify across all asset classes to balance risks. I rebalance my portfolio every 6 to 12 months to adjust to new economic conditions. I focus on dividend-paying stocks and ETFs to maintain steady returns. This is my approach, but your strategy should match your personal goals and risk tolerance. Common mistakes people make. Now that you know how to invest based on inflation and interest rates, let's talk about common mistakes you should avoid. 1. Keeping too much cash during high inflation. It loses value fast. 2. Chasing high-risk assets during rising interest rates. Borrowing gets expensive and market downturns hit hard. 3. Ignoring diversification. Overloading on one asset class can be dangerous in changing economic conditions. 4. Trying to time the market perfectly. No one can predict exactly when rates will rise or fall. The key is to stay invested and adjust gradually. Avoiding these mistakes will keep you ahead of 90% of investors. Inflation and interest rates impact every financial decision you make. Whether you're saving, investing, or borrowing, understanding these forces is key to growing and protecting your wealth. Here's what you should do now. 1. Look at your current investments and assess if they're positioned well for today's economic conditions. 2. If inflation is high, consider shifting to value stocks, commodities, and high-yield savings. 3. If rates are falling, look at growth stocks and real estate opportunities. 4. Most importantly, stay informed. Markets shift, but smart investors adapt. If this video gave you a new perspective on investing, hit that like button, share it with someone who needs it, and subscribe for more financial strategies. Thanks for watching, and I'll see you in the next video. Disclaimer. This video is for informational purposes only and does not constitute financial advice. Always do your own research or consult with a financial professional before making investment decisions.